You're a knight. It's 1180. The sun is shining. The crowd is cheering. You ride out into a tournament field on your best horse, wearing 40 pounds of chainmail, holding a lance pointed at another guy who is also holding a lance pointed at you. Neither of you actually wants to die today. This is sport. This is supposed to be fun. Then his lance finds the gap under your shoulder and you feel something cold go through your chest. You hit the ground. Your horse runs off. Your armor will be stripped before sundown. And somewhere, in a house several miles away, you have a wife and 3 children who do not know yet, but their entire world ended at the same exact moment as yours. You did not have life insurance. Nobody had life insurance. There was no policy. There was no payout. There was no guy from State Farm pulling up in a horse-drawn carriage with a check. There was just the muddy field, the broken lance, and the family you left behind, who were about to find out what the Middle Ages did with widows and orphans. The answer is, mostly, nothing. So who paid when a knight died in battle? And here is the wild part. The answer to that question is the entire secret origin story of modern life insurance. Because what some medieval orders tried to do for their dead members, what guilds tried to do for their fallen craftsmen, and what a few cities in northern Germany invented in response, eventually became every life insurance policy you have ever heard of. The story is way more brutal than you think. It is also more clever than you think. Let's talk about what death actually meant for a medieval family. To understand the insurance angle, you need to understand the math of medieval life. If you were the man of the house, you were the entire economic engine. You owned the land or rented it. You paid the taxes. You served in the militia. Your name was the one on every document that existed. If you died, your wife inherited nothing automatically in most places. Your kids were too small to work the land. Your debts did not die with you. They moved straight onto the family. Within months, the household could lose everything. Within a year, the kids might be sold into apprenticeships. The widow might be back at her parents' house if her parents were even still alive. And the property might be in the hands of whoever loaned you money before that tournament. There was no social safety net. There was no inheritance system that protected dependents. There was just the harsh reality of medieval finance. When the breadwinner went down, the whole household went down with him. Honestly, kind of grim. Most families just had to absorb the hit and hope the children grew up before the wolves got to the door. Here is where things get genuinely interesting. There was one group of medieval professionals who actually tried to do something about this problem. The Knights Templar. You have heard of them. They get talked about a lot in conspiracy theories. The interesting part for us is that the Templars, founded around 1119 inches Jerusalem, were one of the first organizations in European history to run something that looked like life insurance. They were a religious military order. They fought in the Crusades. They also became, almost by accident, the most powerful bank in Europe. They handled deposits. They issued letters of credit. They managed money for kings. And along the way, they started writing what historians call annuities. If a wealthy person donated land to the order, the Templars would guarantee a regular income for that person and his family for the rest of their lives. They essentially invented the pension contract. They also covered their own. When a Templar died in battle, his brothers in the order kept the system running. When the order itself was dissolved in 1312, the surviving members were granted lifetime pensions paid from the order's assets. That is not exactly modern life insurance, but it is the same basic shape. You contribute to the pool, you die, somebody gets paid. Crusading was expensive. At the Battle of La Forbie in 1244, only 33 Templars survived out of 300. Replacement costs alone were roughly equivalent to a ninth of the entire French monarchy's annual budget. Honestly, those numbers are wild. The Templars built a system to absorb that kind of loss, because no individual could. Now here is where things get really fascinating. The Templars were not the only medieval institution trying this. Across Europe, the craft guilds were doing a smaller version of the same idea. Guilds were professional associations. Bakers belonged to a baker's guild. Carpenters belonged to a carpenter's guild. Goldsmiths belonged to a goldsmith's guild. If you were a member, you paid dues. And in return, the guild took care of you. If you got sick, the guild paid for a doctor. If you died, the guild paid for the funeral. And if you left a widow and children, the guild kept paying. By the 15th century, the German city of Hamburg had around 100 guilds. Lübeck had 70. Each one ran its own small fund. The cities of Hamburg, Lübeck, and Bremen, the heart of the Hanseatic League, became the laboratory for this idea. Northern German merchants were rich. They were organized, and they were obsessed with risk management because they sent ships into the North Sea and Baltic on a regular basis. When a master craftsman died, his widow could often continue running his shop and stayed connected to the guild. When that was not possible, the guild's mutual aid fund paid out. By the 16th and 17th centuries, this had evolved into formal Witwenkassen, or widow funds, dedicated specifically to paying out when a member died. These funds were the direct ancestors of every life insurance policy that exists today. They started in the trading cities of the German North. They spread across Europe. By the 17th century, English insurers, including the early underwriters at Edward Lloyd's Coffee House in London, were writing policies on individual lives. The world's first documented life insurance contract on a man named William Gibbons in London in 1583 ran on the same logic that medieval German guilds had been quietly using for hundreds of years. Pool the contributions, pay out on death. Honestly, kind of beautiful. Here is why this matters today. Every single life insurance policy you have ever heard of, every term life policy, every whole life policy, every employer death benefit, every pension survivor payment, runs on the same logic that the Templars and the Hanseatic guilds invented. You pay in over years. If you die early, your family gets paid. If you do not, somebody else's family gets paid from a pool that includes your contributions. That is the entire concept. It has not changed. The actuarial math has gotten dramatically better. Edmund Halley figured out mortality tables in 1693, which turned the whole thing from guesswork into science. The amounts are bigger, the lawyers are more numerous, but the bone structure is identical. You are doing what a medieval guild member in Lübeck was doing 600 years ago when he paid his annual dues to the Silversmiths' Brotherhood. He was buying the small chance that his family would not be destroyed if he died young. So are you. So when you fill out the life insurance form, when you name your beneficiaries, when you sign the policy and pay the premium, you are doing what a knight in 1180 wished he could do. You are saying, if I get speared off my horse, my family is not on its own. He never had that option. He had to die hoping somebody, somewhere, would care. You get to die knowing somebody, somewhere, contractually has to. There is a strange and quiet dignity to what insurance actually is. It is not a financial product in the deepest sense. It is a promise from the future to the present. It is the agreement that says, your death will not erase the people who loved you. The Templars knew this. The Hanseatic guilds knew this. Some peasant in a frozen village outside Hamburg in 1450 knew this when he paid his annual contribution to the widow's chest. They all knew the same thing. Death comes for everyone. The damage does not have to. And so they built systems, slowly, over centuries, in different cities and different languages and different forms, all aiming at the same simple goal. Catch the falling family. Hold the pieces together. Make sure that one bad afternoon does not erase a whole future. That is what you are buying when you sign a life insurance policy. You are buying a piece of a very old promise. The knight is gone. The horse is gone. The guild is gone. The Templars are gone. The promise is still here,